Thousands of first-time traders join the stock market every trading session, and thousands of traders leave the market forever to never come back. In both the cases, there are few common things that force them to come in this situation. One of them is greed. First-timers join the market to become millionaire overnight, and the experienced leave the market because they gamble to be millionaire overnight. Hello, ladies and gentlemen, this is Naveen Kumar, and you have started watching my YouTube channel, Option Checkmate. Let's talk about the psychology behind the trade that makes a trader successful or worse. So, what is a trading psychology? In this video, we are going to talk about trading psychology. The term psychology itself is a very powerful word when it comes to define the success or failure in a particular area or profession. If you understand the psychology, you can come out as a winner with no doubt. So let's see what all are the ingredients of psychology. Uh, because we are talking about trading, the stock market, so we will concentrate on that. But as psychology in general term, a very vast area to define with. So let's go ahead. So the psychology is the reaction against a situation that is produced by your brain, and that can be anything. It can be nervousness, it can be overconfidence, or a fear against a situation, or the greed to get something in very short span of time, irrespective of the cost, what you're going to pay for this. Anxiety, the FOMO, the fear of missed out or the missing out. You want to be in a running train irrespective of the consequences you can have if somehow miss to catch the train or somehow if you get imbalanced. And the last but not the least is the doubt. When you are in doubt, you are in trouble. So let's see how these terms or how these situations are related in stock market or in the trading. So if we talk about the nervousness and anxiety, this is a very common feeling but on your body's stress response. This involves series of hormonal and psychological responses that helps prepare you to handle a perceive or imagine threat. Your body prepares to fight or flee a threat by boosting adrenaline production. Almost instantly, your heart begins to beat faster, your blood pressure rises, and your breathing quickens, increasing your alertness and energy. That is how the healthline.com explains the nervousness. How it is applicable in the trading. The one and only one reason of nervousness is overtrading. In a trade, when you put the money, which is more than what you can afford to lose, you start getting nervous when the trade start moving against you. So, and that nervousness and anxiety comes with the consequences. Those are you don't give enough time to your trade and start getting exiting. Hence, you also lose the chance to make profit. Meaning, if you have put a lot of money in a single trade and within second, if it start going against you, you try to get exit of the trade and book the loss. Even though if the market is trying to consolidate before getting a bull run or a rally, you are not able or you're not feeling good and you exit the market. You become offensive to the market. You think the trade cannot go against you and you start averaging down. So more you add the fund to your trade, more you get nervous. Finally, you decide to book major loss that cause major damage to your portfolio, and sometimes you can never recover from the situation. Let's see what's next. Overconfidence. The overconfidence, it is Very, very, very dangerous in any situation, in any industry, in any profession. The overconfidence effect is a well-established bias in which a person's subjective confidence in his or her judgment is reliably greater than the objective accuracy of those judgments, especially when confidence is relatively high. Overconfidence is one example of miscalibration of subjective probabilities. Confidence has been defined in three distinct ways. One, overestimations of one's actual performance. Overplacement of one's performance relative to others. Over precision in expressing unwarranted certainty in the accuracy of one's belief. This is how Wikipedia explains overconfidence. Let's see how it is applicable in trading. So before you trade, let's say before you start a trade, you reviewed the market, analyzed the chart, and found a perfect entry to make position in a trade. For some reason, the analysis went wrong and trade starts going against you. Because you are good in reading the chart and most of the time you have been correct in your analysis, you take it on your ego and you think you cannot be wrong. Market will come back your way. And then the situation start getting worse. You become offensive to the market. You think the market cannot or the trade cannot go against you and you start averaging down. By the time you realize that you were wrong, it's too late. You have already lost a major portion of your trade and you have no other way to recover. The only way, either book the loss, come out with whatever leftover you have in the trade, or leave them in a hope that market will come back and probably you will lose those money as well. So this is always a part of overconfidence. So the next is greed and FOMO. Greed and the fear of missed out is something each and every trader on the planet encounters sometime in their trading career. Some of them understand this quickly and they take corrective action, and some of them take time to understand it and either destroy their portfolio or leave the trading forever. The FOMO is something you try to get on board a running train with the fear that if you don't catch it, it may be too late. Sometimes you might be right, but most of the time it would turn wrong. Due to FOMO, you overpay the market price to get into a trade thinking the stock may rally even higher. How it is applicable in the trading? When a catalyst like a corporate action, an economic event, market action, or any other news that pushes the stock price higher and higher in very short period of time, that triggers greed and FOMO in the traders. Just thinking that the stock will keep rallying, trader is ready to pay overvalued market price for the stock and make profit. And that comes with a cost and consequences. You get into a circuit breaker trade by overpaying the stock price and think that the stock will keep rallying. The moment you enter the trade, stock starts reversing and lose major portion of your cost. In such trade, sometimes you try to average down the trade thinking that the stock might be consolidating to run further, but instead it goes south and you lose a lot of money. The classic example of this recent bull run in AMC and GME. Just imagine about those traders who entered on the top and still bag holding. So never ever try to get into these things, greed and FOMO. If the market is rallying like unexpectedly, it means there is something goofy. It means there are consequences if you get into that. So think twice before you try to get into those situations. So understanding all these points, what is the takeaway from this slideshow? Before starting trading with real money, understand the fundamental of stock market. Try understanding the charts and patterns. Get used to following market news and economic events. Once you're done with this, start doing paper trade for a couple of months. This will give you confidence and you will understand the market psychology. Once all these are done, start trading with real money with a very small fund that you can afford to lose. Last but not the least, always trade with bracket. What is bracket? We will discuss more about this in next video that will be launched in our channel. So for now, for the trading psychology, this is all uh, we wanted to tell. But these are the theoretical. Now let's take a look into a real time into the trading application, how it is impacting the traders across the globe. Okay, so let's take a look into this scenario. It's October 12th, the market is about to open, and because it is going down, I am thinking that Tesla will still keep going down, so I am buying a put option that is expiring after 2 days, which is on October 14th. So this is where currently it is 550. So uh, 550 bid price for the 215 dollar put expiring October 14th for Tesla. So I selected put because I think that it is going down, so it will keep going down. Let's see what happens. And go trade, and I say one send auto, and the moment it opens, I will buy it. I say buy market. So let's see what happens. So market is about to open in just 10 seconds, and I have placed a bid with market price of Tesla 14th October $215 put. Let's see what happens. So market is open, and let's see where it goes. Okay, did not. Okay, so I got this in $6.10, which is basically 610. So you can see that the Tesla price is profit loss is showing $52, right? $60. So because it is continuously going down, okay? So I'm thinking it will even go further, so I will hold it. Let's see what happens. So $7, right? It keeps going down. 710. I'm $100 up within few seconds. You can see that. So now I'm getting greedy. So I think it will still keep going down. So you see 110. Keep going down. Keep going down. Right? Okay. $110. 112. continuously going down. Now you see all of a sudden it's trying to bounce back, right? So now it's 730, 740. See $132 in just 2 minutes of market open. $125 in just 2 minutes. You can see that. Let's see how far it goes. I'll keep holding. Let's see where it goes. I'll hold it because I think it will go down and see what happens. $115 still in profit. $125, 127, $125 profit in Tesla, $127 in 3 minutes, $32, $135. So logically, $130 in just 2 minutes is unexpected profit. So logically, I should get out of the trade with this profit and mark it as a day. But I'm getting greedy. I'm still holding, and it is giving me $155 still, and I'm holding it. You can see that. And now, because I holded it, and it is trying to push it back. See, all of a sudden it became 102. So price is going down. It's going down. Now I'm just $2 up. See this? This is real example that any can get into trap. I was supposed to take the more than $100 profit in just 3-4 minutes, and now because my greed hold me here, and I kept holding the option or the contract, expecting that it will keep going down and I will make more money. But what happened? Now it looks like my trade is going against me. And you see this? Now it is going against me. So it is may cause problem. Like if I do not back out here, I may lose money. So what I will do, I'll say, okay, go ahead. You see this? Now I am in loss. $15 loss, $50 loss. See this $50 loss just in a fraction of a minute. Just few seconds back I was $100 up and now I am $40 down. So what I will do, I will go ahead and sell it in the market. And what happened? Take a look. I sold it with $25 loss. It was $150 up, but my greed forced me to stay in the trade and that resulted into the loss. See this? Just keep going up. So this is what happens when you let your greed dominate you, and that's how you get into the trouble. So never try this. If you are in profit, get out of the trade right away and mark it as a day. Don't try to be a billionaire or a millionaire in just one trade. Nope, you cannot do this. No one can do this. So get out of the market, take your profit, and be happy. Thank you.